the deputy, talking to us about Texas, teaching us everything that we need to know, what we think we know, and then what we don't know. But beforehand, I just wanted to point out that our business on the green is July 27th. We still have a few sponsorships available if you want to do a hole or if you want to just come play golf. And then our Leadership Greater Augusta program, the application just opened for that too. And we'll close on July 13th. So I will turn it over to you, Matt, and I'll let you tell us a little bit about your business.
Sure. So I appreciate Matt giving us the opportunity to come and talk to you guys. I had a question earlier, where are we located, what do we do? Well, my name's Matt Hale. I'm the manager with Hantzmon Wiebel. We're located down in Charleston. We have probably about 90 employees, 65 of which are CPAs or accounting professionals. We are locally owned and operated. We have a pretty large footprint here in the valley. Let's see here. We serve a lot of industries out there. We have manufacturing, agricultural, beer and wine. We do a lot of business valuations, audits, taxation, going through the gamut. And Larry Martin here is going to be doing the presentation today talking about tax law. He has about 40 years or 4 decades of experience.
I started when I was 3.
But it's kind of nice because Larry actually teaches the professionals about tax law, so he knows his stuff inside and out. So with that, I'll let you.
As Matt said, our firm is, there in Charlottesville, and I feel like we kind of got the best of both worlds. That we're locally owned and operated. We focused on Charlottesville and Shenandoah Valley and Central Virginia, and yet we're big enough to have the expertise to handle just about any type of tax, financial audit, or whatever else. And we, over the years, stuck to our knitting. We have gotten in, we do tax work, we do audit work, we do, other business-related things. We don't sell securities, we don't sell insurance, we don't, do headhunting. We basically stick to what we do and basically trying to help our clients be successful. And so it's when I got out of school, I'm a Wando, grew up in Charlottesville and then got out of Virginia. And it was, Hantzmon Wiebel was the firm that you wanted to be with and stay with, and I've never looked back on that. So we feel very fortunate to do that. For that background, what I'm going to try to do today is spend just a little bit of time really talking primarily about what we call the Tax Cut and Jobs Act of 2017. It was passed in December 22nd. And so it was generally effective 2018. So we're in the midst of the first year of what's in all this new tax law. Kind of looking back, the tax law gets changed every time that Congress meets. They change something about it. There was a 39 code, there's a 54 code, and in 1986, some 30-some years ago, they did some major revisions. They didn't renumber the code this time, but it's probably the most expansive change in that last 30-some years. And one of the problems with it is that there's a lot of it that got passed at the last minute. There are not regulations and guidance out there on it. So we are now, 6 months into the year, and we don't know the answers to an awful lot of fundamental questions. You can go read what Congress passed, but how does the IRS intend to issue guidance and make it work? They haven't done it. Now, I'm not going to defend the IRS a lot, but at the same time, they are understaffed. They're on demand. Congress has cut their budget. They've lost, like a lot of businesses. All of you are in business. You've seen the brain drain that's gone out of businesses in the last 3 to 5 years, and will happen over the next 5 to 8 years of senior people leaving. The IRS has had some of the same problem, and so a lot of their experience is gone. And so then they have to just react to whatever Congress does. So I mean, I'm not going to defend the IRS. They've created some of their own problems, but there are some. In any event, so basically, again, what we want to do today is highlight some of the biggest changes. I mean, I could stand up here for the next 2 days and talk about what changed in the tax law. And there are a lot of nuances, but what I'm gonna try to do is just hit the high spots that affect primarily individuals and small business, because that's basically what the chamber membership was about. So with that, so again, it's the most extensive tax law change since the '86, since they actually rewrote it and renumbered it. Again, we're only going to cover a fraction of some of the changes. And as I said, guidance has not been issued for significant portions of it. And so it's just kind of stay tuned and we'll figure out where it goes. So, I put a few little quips in here, which I like, and a Will Rogers quote that Congress obviously doesn't dictate, dictates tax laws. Anyway, so people look at Matt and I and say, you know, a lot of the body of knowledge that we work with is a bunch of rules that Congress made. It's not easy, but again, the rewarding side of it is that there, unfortunately, or fortunately, whichever you want to look at it, is there's a reward for, if you will, playing the game. In other words, businesses and individuals that are doing business transactions, if they've got good advice, they can cut their tax bill, do it in a tax efficient manner. And, you know, I hope, we were talking earlier, I hope all businesses make money. I hope they have the opportunity to pay taxes, but then you get into pay what you owe, don't leave a tip. So don't pay more than what you owe. So let's start a little bit with some of the things that changed in individual tax. First thing is that they have eliminated personal and dependent exemptions. If you think about it, everybody on their tax return, whether you itemized or not, you got a personal exemption, and the size of your family and whether you were single or married and whatever, that has been in effect done away with. And when I say done away with, it is suspended until 2025. So basically in 2026, the law comes back kind of like it was. That, my best prediction is that's not going to happen. I mean, between now and then, you know, you don't know we'll have a different president, obviously that far out. You know, we have a House and Senate midterm this year. As the politicians change, tax law will change. They make stuff and they call it permanent. It's permanent until the next time Congress meets. So, you know, whether this stuff will still be around in 2025, I kind of doubt. But so some of this stuff is actually suspended, but effectively everything I talk about is effective for this year and will probably be for the next few years. Personal exemptions are gone. Who is a dependent still matters. There are things like child tax credits and there's some other things in the tax law. So, you know, figuring out, you know, complicated mixed families, you know, kids living with two parents, which one gets a dependency exemption and stuff, still matters because there are other things, even though you don't get a personal exemption, you know, who gets the child tax credit, who gets certain other things that go with somebody being a dependent of another are still in the tax law. So you can't just say, well, it doesn't matter whether the kid's a dependent of yours or not, or in college or not. It still matters. You just don't get an exemption for it. The second major thing that they changed is miscellaneous itemized deductions. There are about 160 million individual tax returns filed every year in the United States. And heretofore, basically, about 120 million of those used a standard deduction, and then 30 or 40 million of them used itemized deductions. So when you itemized deductions, you had charitable deductions, you had medical, you had taxes, and then you had miscellaneous itemized deductions, which included everything from tax preparation fees, you know, say deposit box fees, investment management fees, if you happen to have that. If you're an employee and your employer didn't reimburse you for all of your expenses, you could have employee business expenses. All of that's gone. Boom. No more miscellaneous itemized deduction. If you've got a professional investment manager, the fees are no longer deductible. If you've got unreimbursed employee business expenses, no longer deductible. So all of that has just been taken out of the tax law.
Can I ask you, so that's like the 2106 is still gone?
Yep, it's gone. Boom. Yeah. Hello. Um, So that they took, out of the tax law. And so when you get back to concept, they lowered the rates a little bit, but they also raised, what the base is gonna be, and you'll see an example when I get to the end of it about that. So they eliminated miscellaneous itemized, they eliminated the personal exemption. The next thing they did is they limited the amount of taxes that can be deducted. It used to be, if I lived in a high tax state like New York, and I had, having somebody that had $4,000 or $5,000 worth of real estate taxes in New York was nothing. They may have had another, $10,000 worth of state income taxes and whatever, they could deduct all of that. The original proposal was to do away with any tax deduction as an itemized deduction. The compromise was that's limited to $10,000. And so if you're here in Virginia and you itemize deductions, then you only get $10,000. And whether that's real estate taxes, state income taxes, and how Virginia is going to adjust for that, we don't know. We don't know what Virginia is going to do. But bottom line of it is that your tax deduction on your miscellaneous itemized deductions now is limited to $10,000, whether it's personal property taxes, whether it's real estate taxes, whether it's income taxes, doesn't matter. $10,000 is all you get. Boom. And so a lot of people that if they don't have a big mortgage now with no miscellaneous itemized, no employee business, a lot of the others, they're going to be forced into a standard deduction. They did increase the standard deduction for a married couple. It's now $24,000. And the whole goal of the thing is that they basically want to have less people itemized. And we don't know yet, but one of the guesses is that instead of 110, 120 million people using standard deduction out of that 150 or 60 million returns, it'll probably be something in the 130 or 40 million will use a standard deduction because of the big number. So in other words, that without, with no more miscellaneous itemized limits on the taxes, that a lot more people are going to be using the standard deduction on their individual return. One of the other major changes that affected a lot of people was the alternative minimum tax, and that was a kind of an alternative tax system that started a number of years ago, where people got tax write-offs for certain types of depreciation or certain other types of deductions, and where some wealthy people were not actually paying very much tax because Congress says, we'll give you a tax break for doing this, this, and this. And they went and did this, this, and this, and then they ended up with no tax bill, and somebody said that's not right, so they put in this alternative minimum tax. There was a proposal to do away with it. They didn't, but they did scale it back so not as many people would be affected by it. And the interesting thing is that the things that caused a lot of people to get into alternative minimum tax was a large tax deduction and their miscellaneous itemized. Well, they did away with both of those, so less people can be an alternative minimum tax anyway. The significant thing that was done, they did reduce the individual tax rates, and across the board, they did narrow the brackets a whole lot. We'll see a chart later, and I think the charts actually should be in the printouts of having, so you'll see where they did scale the rates back some. The next thing they did is they increased the child tax credit. And that was a compromise that Rubio out of Florida insisted before he voted for the bill, and all the political trade-offs that went, and I guess all legislation's done with that with a lot of trade-offs, but this one was just rampant. It was in the public eye. But the bottom line of it is the child tax credit now, if you have children under age 17, it's a $2,000 credit, and $1,400 of it can be refundable, meaning that if you didn't have other income tax, you can actually get part of the tax credit back as money, even though you didn't pay it in. So it's actually refundable. So again, they reduced the rates, they increased the child tax credit. One of the other big ones that's going to hit an awful lot of people is they eliminated home equity interest deduction. They changed the home mortgage. It used to be that you could not have a mortgage bigger than $1 million. They changed that to $750,000 for new mortgages. That's okay. And, okay, so, and that will affect a small segment of the housing market. But the big thing they did is that anybody that has a home equity line of credit, where you could go spend $100,000, whatever you wanted to, and you could deduct the interest. Now, effective now, with no grandfathering, no more home equity deduction, period. So if you had a home equity line last year and you deducted the interest on it, 2018, you're not going to be able to deduct that interest. And some of the bankers could probably tell us whether that's, what's that change for the marketability? Will people still do home equity lines where they can't deduct the interest? I don't know, but that deduction is gone. Well, the other one's interesting that they changed, and this is effective in 2019, is alimony. And basically, the way alimony works is that the paying spouse got to deduct the alimony, and the recipient spouse had to pick it up in income. And if you think about the system, typically the high wage earner or high income earner is paying the other spouse, who's the lower one, and in effect, the deduction was getting taken in a high tax bracket, and it was getting taxed in a low tax bracket. So effective for new divorce agreements entered into starting next year. So the old ones are grandfathered. But if you've got somebody that gets divorced in 2019, and there's an alimony agreement, the alimony will no longer be deductible, and nor will it be taxable. In other words, the Congress says, y'all work out your deal. Instead of getting, $5,000 a month and it's deductible, and somebody's receiving $5,000 as taxable, you need to figure out maybe the new number is $4,000, or make up a number, whatever you want to. But the government is no longer going to let somebody deduct it in a high bracket and tax it in a low bracket. It's a revenue raise reform. So, but that's effective next year. And if you have old agreements, as long as you don't go mess with them, they're grandfathered. They changed the medical deduction. There was a talk about doing away with the medical deduction. And then, as most of you know, to take medical expenses, they had to be more than 10% of your adjusted gross income. Well, for 2018 and 19 only, they changed that back to 7.5%. And again, a compromise to get some senator or House representative, probably a senator because it was a closer vote, to vote for this. They said, okay, for these 2 years, we'll change it back to 7.5%. One of the other ones, and again, a lot of this, posturing came about is Section 529 plans. Most of us are familiar with a Section 529 plan. Virginia has one, as most states do. And a 529 plan is a plan where I put money in after-tax dollars. It's dollars I pay tax on, but all the earnings. So if I've got a grandchild that's 1 year old and I put $10,000 in there for the child, by age 18, hopefully that $10,000 is $25,000. That $15,000 in income, if the money is spent on college, tuition, etc., is non-taxable. What they changed in the law effective now is that you can use up to $10,000 of that money now for, secondary school and elementary school and private schools. They wanted to make it, some people wanted to make it unlimited, some people didn't want. The compromise was that now you can use $10,000 out of your 529 plan to go to St. Anne's Belfield or go to one of the private schools over a year. You can do that. What is interesting about that, and I don't know what Virginia's going to do, if you're familiar with this, when you put money into a 529 plan, you've got a $2,000 deduction for funding the plan on your Virginia taxes. Well, if I don't do anything else, and it's not a big number, but if I go, I've got a couple of kids and I go put $10,000 a piece in each one of them in 529, I've now got a couple $1,000 deduction on my Virginia return. Even if I turn around the next day and take the money out and pay it to the school, I've just made money on my Virginia taxes. Whether Virginia is going to outlaw that, Virginia, our General Assembly meets every year, and in January and February of every year, they tell us what the tax law is going to be for the prior year. So next February and March, they will tell us whether they're gonna follow any of these rules. Right now, we have no idea.
And returns are due on April 15th.
May 1st for Virginia, but, and for most years they get the law passed before the due date of the return. One year they didn't. They went into an extended session and they passed the law retroactive, and did it on like May the 14th. So, interesting.
It doesn't make y'all's life easy.
No, it doesn't. One of the other ones that they eliminated the moving expense deduction. If you're a business that has a relocation plan for a new employee and you reimburse them for the moving van and their relocation expenses, you can do that with a before tax dollar. The business deducted it and the employee picked it, did not have to pick it up in income, no more. Done. If the employee paid it themselves, that was one of those miscellaneous itemized deductions. If the employer pays it now, first dollar goes into their W-2. Moving expense. There's an exception for military, and there's exceptions in here for a lot of things, military for a lot of it. But moving expense, so if you're a business and trying to hire somebody and they've got to relocate to this area and say, hey, we'll give you $10,000 for the moving van or whatever else to get you here, you can still do that. It's just now it's taxable income.
How about for a church that relocates a minister?
Taxable income.
Wow.
It's a military church.
Yeah.
Kitty tax. Anybody that's got children with income over it's like a $2,000 or $3,000 limit. That basically the whole idea was that people were putting money in, high income taxpayers were putting money in their kid's name, and the kid was paying less tax. So they came up with this kitty tax years ago and made it taxed at the parents' rate. What they're doing now is they're basically they're not going to tax it at the parents' rate, they're going to tax it at trust rates, which means basically if a kid has, say, a trust fund or something like that, and they have like $12,000 worth of income, they're in the top tax bracket. It doesn't matter. It used to matter what bracket the parents were in. Starting this year, all kids that have income, other than earned income now, if they have a summer job or something like that, up to the amount of the standard deduction, they still get that out. But if they have investment income because granddaddy left them a trust or something like that, they're going to pay the top tax bracket. This is one that hits a lot of people, as you know, whether you give it to the Virginia Athletics Foundation or. And I know about the Hokie Club because my daughter, due to a lack in her upbringing, went to Virginia Tech. But and she gets to the Hokie Club. But it used to be if you gave money to an athletics foundation and you got rights to, you didn't get free tickets, but you got the right to pick where your seats were. That was 80% deductible. They said the price tag, because you got something back for it, 20% of it's non-deductible, 80% of it was still deductible. Starting this year, zero deduction. Been eliminated, boom. So unless if you give money to Athletics Foundation, Hokie Club, whatever, now you get zero deduction for it unless you disclaim all rights. If you disclaim all rights, you get no seating preferences, you get no other rights, then it's treated like any other charity. But most people don't do that. And how that will affect Athletic Foundations, who knows?
How do you disclaim it?
All the contribution forms have a way on there. I know the Virginia Athletics Foundation says, I hereby, when you send the form in with your check, you say, I disavow any advantages. They don't give you any priority points. They don't give you any seating preferences. They don't give you, free stickers. They don't give you anything. There's a checkbox typically, and you just tell the organization, I don't want any of that stuff.
But if they let you know about upcoming, you take it by tickets first before it becomes available, is that enough?
That's a ticket preference. Can't do that. You get treated like you didn't give them any money. You get treated like the general public.
You obviously, you're a law, so you get that information from
Absolutely. Yeah, and and now what money I give to the Virginia Athletics Foundation is no longer deductible.
That sucks.
Yeah, I mean, yeah. And I'm one that, because both my kids went through college on athletic scholarships. So I mean, I think it's a great program, but basically it's going to make it harder to raise athletic scholarships.
And that's the reason why donor advised funds can't contribute to those as well.
Now, donor advised funds, well, yeah, that's part of it is because somebody got some, well, you'd already gotten a tax benefit for it. And now if you get, and from a donor advised fund, which is really not your money anymore, you got the tax deduction when you gave it to the community foundation, whoever you gave it to. And now if you get any benefit from that, that's why you can't do it. And so there's no way to disavow the benefit. So a DAF cannot be used to give to where you get some benefits, and athletic foundations is one of the primary ones. You also can use a DAF to satisfy a pledge that you made. They can't satisfy your obligation because it's not your money. I thought this kind of summed up the kiddie tax.
They don't like it. They don't like it.
I can't read the eat to.
I'm sorry, teach your kids about taxes, eat 30% of their ice cream.
Oh, okay.
I'm sorry. All right, so let's move, all right, so some things that did not change. The dividends and capital gains rates, which get preferential tax treatment, that's the same. Capital gains, dividends did not change. You got to exclude the gain from the sale of your primary residence. Most of you know if you've been in your house for more than 2 out of the last 5 years, you sell it, $250 a person, $500,000 a couple, and basically that did not change. The employer provided dependent care assistance did not change. So in other words, if they're giving you some benefit to use for dependent care, primarily child care, but it could be an adult or whatever, that did not change. That can still be done in a cafeteria plan with a pre-tax dollar. The net investment income tax, which is the 3.8% Medicare tax, that didn't change. So people that have more than $250,000 of adjusted gross income still are going to pay that. The ability for if you have somebody who is age 70 and a half and have money in an IRA and want to give a deduction directly to charity, where they have the IRA give the money to the church or whatever, that is still in the law and actually may be more attractive now because if losing all these other deductions and they can't deduct their fees for the investment advisor and they're going to use a standard deduction, then using the QCD, the qualified charitable distribution, makes even more sense. But that's, that's still in the tax law. So here's basically kind of a rate table thing that you'll see, and it should be printed in there. It's probably too small to read. But you'll see that, the top bracket dropped down a couple percent, but they widened some of the others, of where the brackets go. Let's look at an example here. So basically, we've got Joe and Sally, and they've got 2 teenagers, and last year they were age 15 and age 13. And you go down the left side here, and so they come down and they got their charitable contributions and their real estate taxes and the mortgages. And then they got 4 personal exemptions, and they ended up with taxable income of $66,000. And the tax on that was $9,000. You got a $2,000 child tax credit. So the net federal tax liability was $7,000. So this year, they're not going to itemize anymore because you see the standard deduction is $24,000. And without their other deductions, they just decide to use the standard deduction. They get no personal exemptions. The taxable income went up by $10,000, but because of the new brackets, the tax actually went down. Not a whole lot, but some. But now, because of the child tax credit, that's $2,000 a kid, they basically are going to pay $2,300 less in 2018 than they did in 2017.
So who has Jay and what's their name?
Very finally joined.
Okay.
Now, next door to Joe and Sally are Bob and Sarah. And Bob and Sarah have twins that were 16 years old last year. And so their left-hand column looks exactly the same. But because their twins are 17 years old this year, they're juniors or seniors in high school, they do not get the child tax credit. They only get this $500 credit instead of the $2,000 credit. And they're gonna pay $663 more this year than they did last year. And if I'd asked you before we started, here are two couples, both got kids, both teenagers, both in high school, whatever else, and you say, how'd they come out under the new tax law? That's what we mean about winners and losers. It is so fact specific. And so here, they're basically got a $600 tax increase, the other people say $2,300.
Do they have to verify when these children were born?
Absolutely, I mean, you got, so, I mean, and you go on your tax return, you gotta put a date of birth on it, you gotta put, social security numbers and stuff. That led us to the new tax form has been released for this year, it's got 3 new filing statuses on it, confused, disgruntled. So let's talk real quickly about employer-employee. Like I say, we eliminated the moving expense. That affects a lot of employers. It eliminates entertainment expense. It used to be if you did business entertainment and you could prove it was part of it, connected with a business, you at least got a 50% deduction for it. Starting this year, no more business entertainment. And a lot of the meals and other things like employee meals and stuff like that are going to a 50% deduction. So entertainment expenses gone, period, for both the employer and employee. And a lot of the meals and stuff are going to 50%. As we talked about, the eliminates employee business expense back over where we talked about no more 2106s. Now, if you're self-employed and you got a Schedule C, you can still have, expenses there, subject to, you still can't be entertainment. But the unreimbursed. So if you're a business and you can reimburse somebody for mileage, for example, then the business can deduct it and they don't have to pick it up in income. If you had in the old days of, we're not going to reimburse you, but you can take a deduction for your own business mileage, they can't take that anymore. So, maybe as a business, you need to rethink a little bit of how you do that. Yes.
So food versus entertainment would be like, I got 3 minutes to my next appointment, so I buy something for me to eat.
That should be a meal as opposed to.
Or I take a client out there really long and
That's entertainment, probably, non-deductible. The Affordable Care Act, Obamacare, had an individual mandate penalty in it. If you remember, if you filed your tax return, you had to tell them whether you had health insurance coverage, and there was a penalty of like $700, or it could be bigger in some cases. Starting in 2019, the Republican-controlled Congress did not eliminate that penalty, but starting next year, the penalty's still there. The penalty just is 0. They couldn't repeal the law, so they just changed the rate to 0. And they rewrote, all the withholding tables. Some of the benefits, what they do in the benefits area. Qualified retirement plans, where you put money in a 401k plan, who could put money in an IRA, so none of that changed. So, maybe, that still, I think, is a very attractive way, and if your employer's got a match in a 401k or something like that, they did not change any of that. The large employers who have more than 50 employees, where they had this mandate under the Affordable Care Act, and you had to furnish coverage, that did not change. And they are looking at that now. We've had a couple of clients that, one of them in particular did not fill out a form right and made it look like they didn't furnish coverage to everybody. They did, and hopefully we'll get it straightened out. But they had one person who went to the healthcare exchange, claimed a premium credit after they'd been offered healthcare insurance. They got the employer got a $400,000 bill from the IRS. So I mean, it's and these are coming out right now in tax year 2015, 2016. But none of that changed. The mandate for employers, large employers, having to furnish health care, that's still there. One of the things that also didn't change, is probably good news, is that an employer provided health care, the premiums can still be deducted by the employer and non-taxed to the employee. And, they haven't put lids on that yet. That, whether that's coming, obviously, y'all can probably tell me horror stories about what's happening in the healthcare premiums. But right now, that's huge, of being able to have it as a business expense and not have it as taxable income to the employee. IRA deductions are basically unchanged. People who put money in an IRA or a Roth IRA, those groups. Again, smart people and how they deal with tax law. I got this quote from Albert Einstein, and he died in 1955. And this, unlike the Lincoln quote, this is supposedly an actual quote. But it certainly hasn't gotten better in the last 50 years since then. Business tax, what they changed? For C corporations are not S corps, not partnerships, corporations that pay their own income tax. Mostly publicly traded companies, ones that have foreign owners, et cetera. We had a tax rate of 35%. It was the highest tax rate in the industrialized world. You read a lot about, all these multinational corporations taking money offshore. This is why. Because the average rate among industrialized countries was in like the 22, 23% range. And the U.S. was taxed at 35%. Well, if I'm Procter & Gamble or Pfizer or whoever else, I'm going to take money offshore if I can. And so basically they changed that corporate tax rate to 21%. Now, it's still subject to double taxation. So if you have a C Corp, Procter & Gamble, they pay now 21%. You're still going to pay tax on the dividends. If you have your local business and operates as a C Corp, which we don't see very often, now they'll only pay 21%, but they're going to pay tax again on the money when you take it out. So it's still a double tax system. And one of the questions that comes to your mind is, if you're a partnership or an S Corp, is being a C Corp now and the double tax a better deal? The answer is no. It's a pretty unique. We've done a lot of analysis for a lot of clients, and the general rule is it's still going to be better to be a pass-through entity, but they did change the top rate for corporations, and it does make us more competitive on a worldwide basis, which clearly needs to be. They repealed the corporate alternative minimum tax, which affected a lot of particularly bigger businesses. For those of you who are familiar with it, they had a thing called the domestic production activities, or DPAD, where basically manufacturers who made something got to take 9% of their taxable income and just throw it out as if it wasn't taxable because they were a manufacturer, a domestic manufacturer. It was a reward for domestic. That got repealed. That has been eliminated as of this year. So no more DPAD deduction. We already talked about it. Eliminated the business entertainment. Another big thing they did in the business area, they eliminated net operating loss carrybacks. When 2008 happened, a lot of businesses had a lot of struggle, lost a lot of money. And part of the money that went back into the economy to rebuild it was that you had a net operating loss from 2008, and you could carry that loss back and get some of your 2006 and 2007 taxes back. In other words, you could take that loss and take it back and get taxes back from a prior year and use that tax refund to help rebuild your business. They've eliminated that. So if you have a business loss incurred in this year or a future year, you can carry it forward indefinitely, but you cannot carry it back anymore. No liquidity being created by business incurring a loss. The other big change is that it used to be if I had losses in my business and then the next year I had a profit, until I got cumulatively to a profit, I could use the operating loss to totally offset year two's income. So let's make an example. I lost $50,000 last year, and this year I made $45,000. In the old law, I could use that 50 was bigger than the 45. I didn't pay any tax this year. Starting under the new law in 2018, $50,000 loss last year, carry it forward. This year I made $45,000. I will pay tax on $9,000, 20% of that $45,000, because I can only use the NOL, the net operating loss carry forward, to offset 80% of the income. So I don't have to cumulatively get well before I start paying tax. Another one that's huge, that's gonna affect a lot of businesses, an awful lot of businesses, is this. Tax-free exchanges, we think of, tax-free exchanges, we think about it, those of us in the real estate industry, and I own Blackacre and I wanna go buy Whiteacre, and I can basically find somebody to buy Blackacre from me and escrow the money, and then I can go buy Whiteacre, and I don't pay tax on that gain, I just defer it into the next month. The more common one that a lot of people didn't think about is in like-kind exchanges. I'm in the trucking business. I've got a $100,000 truck and I've written it down to zero. I've depreciated it until it has no value. And I go trade that truck in. Happens all the time. And the dealer allows me $60,000 for the truck. I get a new truck. I give him my old truck and $40,000. And I've now got, and because I swapped a truck for a truck, it was like-kind exchange. And I just took the new $40,000 and depreciated. Not anymore. Tax-free exchanges now only work for real estate. So if I'm trading from a farmer, trucking company, anything like that, if I trade in a piece of equipment, whatever is allowed on the trade-in creates taxable income to me. Yeah, and so basically that's going to change. So it used to be you didn't, you really was like, what's the difference? Whether you're giving me, whether you're selling me a new truck for 110 and giving me 50 for my old truck, or, or 100, just tell me how much the difference is, and I didn't care. Now you might care because it's going to affect your taxable income. So that's going to be a huge change for most businesses. They did change the expensing of assets. In other words, and to allow businesses to buy assets and write them off immediately in order to give, more incentive to invest in capital goods. The 179 deduction, which means that I can buy a piece of equipment used in my business, it was a $25,000 write-off, and then they made it a $50,000 write-off, and then they made it a $500,000, and then they moved it back. It is for, right now, it's $1 million worth of equipment, which covers an awful lot of equipment. And in my example where I traded the truck in, yeah, I got taxed on the old one, but if I get to write the new one off, I probably end up pretty much at zero, as long as this is in. Some states follow 179, some don't. Virginia happens to follow it right now. So they have increased the expensing of assets. So most people most businesses, small businesses that want to buy a piece of equipment, they just write it off when they buy it, which is a pretty big tax break, and they're gonna pay Kathy for the next 4 years on their business loan. So they haven't even finished paying for it yet, but they wrote it off on tax purposes. Bonus depreciation, which is something they put in 2008, that has been at 100%, it's been at 50%, it's now back to 100% until 2023. So again, now the big difference between, what's the difference between $1 million for 179 and a bonus depreciation? If I, obviously one could be a bigger number. If I go buy a, $2.5 million piece of equipment for my manufacturing plant, under bonus depreciation, I can write it off on 179. I couldn't. Virginia does not follow bonus depreciation, so you've got to write it off over a bunch of years for Virginia. Virginia does follow 179. So how states are going to tax this? Well, if Virginia next year when they get together in February and March, I'm going to say this $1 million is too big. We're not going to follow that anymore. We don't know. The other big change is that bonus equipment used to be only for new equipment. It's now for new and used equipment. They changed the write-off for certain building components for roofs, HVAC equipment, stuff like that. It used to be put a roof on a building and you had to appreciate it. Now you can write it off. A few other things, and this doesn't affect, businesses that can use a cash method of accounting, which has some different rules and stuff. That's, that has changed for more small businesses. Their definition of a small business is a business with 25 million or less in gross receipts. It's, but, and you think of $25 million worth of sales is a lot, but I got a car dealership, it's not a great big number. You know, if I've got, you know, a chain of grocery stores or something, it's not a great big number. I mean, my margin's really pretty thin on each unit, but can I pile up a pile of dollars? So, I mean, you think around, I mean, you look around, you know, Augusta County, and there's a pile of businesses that have got more than $25 million in grocery receipts. It doesn't make them making a pile of money. Let's slip some of that. I'll basically close out with the other one that is probably one of the biggest changes that has come about is a special rule for pass-through entities. When I say pass-through entities, I'm talking about S corporations and partnerships, which includes limited liability companies. Most limited liability companies today are taxed as partnerships, so they're pass-through entities. What Congress decided was that we have now lowered this corporate rate from 35% to 21%. If I'm in an S corp and my top tax bracket as an individual is 35%, that's not fair to have a corporate rate over here at 21%, and me, just because I chose to be a pass-through, single layer of tax, ought not to be paying at 35%. We've got to do something for small business. Small business is where all new jobs come from, and a lot of that. So what they did is they came up with this concept where they have a thing called qualified business income. We've started calling it QBI. That basically, if I have an S corp or partnership, not my salary out of it, that's still taxed at normal rates, but the business part of it, I can reduce it by 20%. And effectively, what that does, even if I have a pile of other income, or no matter how big that number is, if you take 20% off the 35% tax rate, 7.4, and basically you end, or at 6 point, you end up at 29.6% tax rate. That's 35, 37, I'm sorry. So basically, if I've got a small business, I'm running a trucking company and I'm making, you know, $500,000 a year, I can take $100,000, 20% of that $500,000, and I don't pay tax on it. Now, that's the good news. The bad news of it is, if I have several rental properties, is that a trade of business? What constitutes a qualified business? That's where we don't have any guidance yet. They haven't decided. Some business situations are pretty straightforward. Some of them we don't know the answer yet, and the IRS supposedly is going to give us some guidance by near the end of the year. But for most of the businesses that we do, they're either partnerships, LLCs, or S corps. And we think a lot of them are going to get a fairly substantial, but when you're trying to figure out what your tax is for this year, should I buy a piece of equipment or not, and doing all the tax planning, we can't totally tell them yet what the answer is going to be for 2018, even if they say, here's our projections, this is what the business looks like. We can't tell exactly how these rules are going to work, and the IRS has not issued any guidance yet, and most likely it will be close to the end of the year before we get to it. So basically that, and again, that's one that's pretty much the what I've got went over. It's like I say, it's a sliver of what's in the tax law, but it's the things that I think is going to affect most people. They're winners and losers, depending on how old your kids are, a lot of the other things, whether you itemized or not, whether you use your home equity line. I mean, there's just so many moving parts that have changed. And if you're a small business, getting good advice of trying to figure out what this is going to look like. Somebody mentioned earlier, to sit down, and we encourage our clients to sit down. Let's sit down in November and December and decide, if you're getting ready to buy a piece of equipment, should you do it this year? Should you do it next year? It doesn't make the equipment free, and it probably shouldn't make you do something that you wouldn't otherwise do from a business standpoint, but the tax result clearly can change when you do it. Should you do it in 2018? Should you wait until 2019? So again, I think it's going to present us some opportunities.
So Larry, I have a college-age child that I've been claiming, and I'm married.
Okay.
So I've been filing as head of household. If she's no longer considered an deduction and she's too old for any considerations does that shift me to single status?
If she is still under 24 and in college, then you're still head of household, because even though you can't take an exemption for her, it still matters that she's a dependent.
Okay.
And you'd get the $500 credit for her rather than the 2,000 because she's over. So yeah, that's back, where we started is that it still matters whether somebody, again, the remarriages and stuff like that, and who gets to claim the kid and stuff like that. All that still matters about your filing status. It matters about the $500. It may matter about the $2,000. You just don't get the personal exemption.
One would think that the attorneys would be all over. You want to get a divorce, you better have an
If you're on the receiving end of the alimony, then I'd say, let's wait.
Yeah, but you're on a planned divorce, yeah.
I mean, we laugh about it, but unfortunately, so much of our world, our business world, our personal lives, divorce, all this other stuff, you can really get hosed if somebody's not paying attention, with a tax.
Have you seen, after seeing this, I'm thinking, oh my gosh, every single person really needs to understand how they're going to be impacted, whether it's an individual or a business. Have y'all seen a lot of your business clients come in and look for some counseling and guidance?
A fair amount, Kathy. We've had a lot of, businesses are saying, should I look at being a C Corp rather than an S Corp or partnership? We've looked at a lot of those. And again, general answer is no, but, I think on an individual basis, not so much. I think some people that, the withholding tables change and stuff like that. There's some people that are going to get a surprise next April that either are going, again, take our two couples, Joe and Sally and Bob and Sarah, that live next door to each other, and they think they're exactly alike and they're making about the same amount of money. And one of them got a $2,300 tax break, and one of them got a $600 increase in the tax bill. And they're sitting there, over, having a glass of wine at a barbecue, and they think they're pretty similarly situated. And come next April, one's going to be happy and one's going to be sad.
I think the size of this room is a commentary. We did, and you can't imagine the kind of creative marketing. We tried to get a room full of people for this because it's so critical, and I just don't think people are thinking about it.
I don't think they are.
I don't think they are either.
We couldn't have people kicking and screaming to come to lunch today, and which is why we moved over here and why the room is so small. And so I just don't think they're thinking about it, and it's going to totally take them by surprise. Now, Matt and Mary did a blog post for us. So if you have people that you want, and it's really solid. It's got all of this stuff in there. That's a great way to share the information with someone that you heard today. If you want it's on the website. If you want to just go on, it's in our blog and grab it, and you can share it with other people.
Yeah, are people doing the planning and the other?
I just don't think they're thinking about it.
Do you think charities are going to start doing some pain?
Yep.
I think so, and I'm involved with a lot of, a number of different charitable organizations. And the age-old debate of, do I give money to, the community foundation, to this, to that, because I get a tax break, or do I do it because I'm a philanthropist? And that's going to really be interesting to see how that plays out. If I can't deduct it anymore, because I'm not itemizing deductions anymore. In fact, I've paid off my house mortgage. I can only have $10,000 worth of tax expense. I can't have any miscellaneous itemized deductions. So I'm gonna probably, now I won't itemize deductions anymore. And so if I don't get a tax deduction for giving to the community foundation, am I still gonna send them a check?
And sometimes you will because you really believe it.
And I'd say churches will probably suffer the least. I think people give money because they have a passion for what the organization does, and do they give a little bit more because they get a tax break? Probably. I think churches clearly will probably be less impacted. Well, athletic foundations, do I give to the Virginia Athletics Foundation because I believe in scholar athletes, or am I doing it only because I got better football seats, or basketball, or baseball?
But it sounds like there's some creative ways, like the advice funds and IRA.
There's
sounds like
ways
there
to
are
do
some
some of
creative
that,
ways to
but
do
it takes
some
some
of
of the bonus. Yeah, it takes some of the. I think there's going to be a better reward. Clearly, there's probably going to be a bigger reward for people who find that, use the IRA deduction. People who lump a bunch of deductions into one year and put it in a donor advised fund. if I'm in the habit of giving away, I'll pick a number, $10,000 a year in charitable deductions, then maybe I do 3 years worth in 1 year, put in a donor advised fund. So now I can take a deduction for it because it's over the standard deduction amount. And then the next 2 years, I use the standard deduction and make my charitable gifts out of my donor advised fund. I mean, there's a lot of different ways to do that.
Did we talk about the donor advised thing earlier and I missed it?
No, that really hasn't changed. I mean,
Oh,
the donor advised funds are basically, some of the big, Fidelity and T. Rowe Price and the big guys have those, but certainly all the local, community foundations have them. And you put money in a donor advised fund, you get a deduction for it when it goes in, but you get to advise, not direct, but advise, I want to give some of this money to, the hospital.
American
I want to give
Cancer
this
or
whatever.
Scholarship funds, community foundations, people will set up a scholarship for students at this school.
So you-
But couldn't give the VA through that, or we can?
You cannot because, well, you can, but you can't get the benefits of buying tickets from VAF. In other words, the money that comes out of the donor advised fund can't give you any benefit.
Is it too late to go back and disclaim that?
Have you made this year's contribution?
Why do it quarterly?
Well, you probably could disclaim it, but,
Or is it
but
some
again,
sports you don't care for?
well,
No,
no, but I mean, are you willing to, as far as the Virginia Athletics Foundation, if you want to disclaim it and you're not going to get any, you've got to give up your football priority tickets, you got to give up your basketball priority tickets. You get no more preference from anybody else. You just like go to public off the street for buying tickets.
Or I still get the Cavalier magazine?
I don't think so.
Oh, crap.
I mean,
I think
So-
it's worth it.
yeah,
About that.
he's not a lot.
Shame on him.
Yeah, question back here.
Yeah, so I would quite interested, especially from the perspective, because we know that 90% of nonprofit funding
Comes
is coming from individuals and their advice funds, foundations, all the above. We've been hearing from some donors that they're going to want through donations, like if they're not going to move it through a donor advised fund or an IRA distribution, that they're going to give to us every 3 years.
Right.
So we're really interested in this because what does that look like from a budgeting perspective from our side of things?
And I think what you'd have to do is, and if I say, okay, here's, I've normally been giving you $4,000 a year, here's $12,000, but it's my 19 and 20 denomination. I think you as a nonprofit organization have got to develop a method to, in fact, put that fund as 19 and 20 funding to level it out. Because if you treat it all as an 18 funding, spend it all, then guess what? So,
Is that going to affect the, their 990 in any way?
Yeah,
Is there-
I mean, on a cash basis, it would, it's going to. If enough people,
Yeah.
are people going to do that? Or, I think there's a lot of people that are just, the ignorance of this new tax law out there is abundant. It's abundant in the community, the business community, it's abundant in the general community. That people just have no clue how they're going to be impacted on it. And they're not trying to find out. They won't find out until next April.
We're also seeing more people move towards donor advised funds and distributions and QCs.
Right.
And then they're also looking to leverage the NAP credits.
Right.
Through the state, because that's not.
The NAP
Until
credits,
February.
the NAP credits are, that works, that will work extremely, it's continue to work
Yeah, I think
extremely.
that's.
But the state, if there's a lid on the NAP credits, and I think they're going to get harder to get.
I would think ask about charitable gift moving forward instead, because from my understanding, there is a tax break when they fund the annuity, then they can take income from it.
Right.
And it kind of spreads out the gift to that organization for a long time. And that organization controls the money, but they're guaranteeing at least some sort of payout to.
Some, whether you do gift annuities, whether somebody's using, charitable lead trust, remainder trust, a lot of what we call planned giving techniques really need to be looked at and decide, whether, how does that, at the end of the day, the the economics of them are gonna be about the same, but and I think what you will really find is whether it's through a donor advised fund, through some type of gift annuity or whatever, where I can lump a bunch of charitable giving in year one and then not make any gifts into year 2, 3, 4, so I can bunch them up and then
So
just
like,
extend
you
it.
did like an annuity where you took a tax break up front that you gave to like an athletic organization, and you used your income stream from that annuity to purchase those savings.
I mean, if you get any benefit for that original gift, it's zero deductible. And, in a bunch of states, California's trying to come up with something, New York, some of the high tax states are trying to come up with some way of, you can make a donation to the state of New York. And if you make a donation to the state of New York, then we won't collect income taxes from you. And therefore, it's a charitable donation. It's not a tax deduction, so it's not subject to this $10,000 rule. And, the IRS is all over that. It's kind of like, and remember, with any charitable donation, if you get anything back, it's not a charitable donation. And whether it's, you're not going to collect taxes from me, you get priority on tickets, you get, if there's any quid pro quo, then it's not a charitable donation. And that's ring loud and true.
So with the home mortgage deduction cap at $750,
Yes.
is that for primary residence only, or folks have multiple?
It's an aggregate.
Okay.
It's an aggregate. And the $1 million is grandfathered. So if you got somebody that's got 900 out there, they're okay until they pay it down. But new mortgages, it's a 750 cap. And then no home equity.
I can't believe the banking, whatever you call it, isn't all over this thing about the equity market. I mean, you would have thought we figured this.
They were trying to get deregulated a little bit more, get rid of Dodd-Frank and some other stuff.
Yeah, well, that's
They had
true.
bigger fish to fry than worried about your equity.
But
Just
I
can't give that
understand
regulation.
from, I'm not in the consumer lending, but I do understand that demand
Or
is
just
very much
stop,
different.
probably.
But, it's a rising interest rate too.
Right.
Equity lines are a variable rate, and that rate is ticked up quite a bit, so, kind of,
You know how they're always pushing those girls.
so it's hard to know what's the
Right.
true driver of that.
Interesting world we live in.
Or how you guys keep, how did you know all that?